Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day, and we are now kicking off the pre-VRIC Summit. Of course, the VRIC coming up January 21st and 22nd. There will be a link in the description where you can get tickets, but we wanted to give you a preview of what's to come and have some of our main keynote speakers on this show. And so I'm very honored to be joined by Gwen Preston of the Resource Maven and Jay Martin, the host of the VRIC, who will also be hosting some panels and discussions for this summit as well. Thank you both for being here.
Thanks for having me.
My pleasure, Jesse.
Great. Well, let's start with gold. And in particular, Gwen, we were speaking before this conversation, and you mentioned that one of the main things you were watching was the fact that the price of gold seems quite disconnected from the mining space, the gold miners, and particularly the juniors. So first of all, why do you think gold is performing so well in the face of positive real interest rates, where people tend to seek out, interest yielding investments such as treasuries? And why have the gold mining shares remained depressed at this point? And Gwen, I'll start with you on this one.
How long do you want me to talk? That's that's like everything, right? For someone who spends their life looking in the gold space. Okay, so why is gold doing well despite treasury yields rising, right? Like you say, usually those move in opposition. In general, people buy treasuries, bidding that price up, and yields go down when things are rough, when there's risk. They need some sort of security, and that's that they buy treasuries and they buy gold. So yields go down and gold goes up. Those usually happen together. Right now, instead, we're seeing yields going higher and gold holding its ground or going up at the same time. What's happening here, in my estimation, is a structural change in that relationship. And it's because we have really deglobalization, de-dollarization. These were really slow, sort of arm wavy concepts for a really long time. I think we're at a point now where they're actually happening in real time. And they're happening in real time specifically in that we have a structural oversupply of treasuries. There's just an increasing number of issuances hitting the market because the US runs an increasing deficit every year and has no way to materially change that. They can't materially raise taxes or cut spending. That's the setup of their political system. So they are a deficit-based system. They've been able to do that because the US dollar has held this different special position in the world for such a long time. That different special position meant that there was always tons of buyers for US debt. That is what's changing. There are no longer always tons of buyers for US debt. This is still a slow-moving change. This isn't like, by tomorrow, all of a sudden, no one's going to buy T-bills anymore. It's still the biggest, most liquid, and most important market in the world. But it is eroding. And it's eroding because China's no longer all the time buying T-bills. Japan has shifted its entire approach to how it manages its bond market and its currency manipulations, and it's no longer leaning into treasuries in the same way. U.S. banks, there's been a pull of capital out of U.S. banks, so they're not buying U.S. treasuries. A huge number of the big buyers of U.S. treasuries are buying less or are even selling. So there just aren't the buyers for the issuances, which keep rising. So you got too many treasuries and not enough buyers. That means lower prices of treasuries. And when prices of treasuries go down, yields go up. So the yield reaction doesn't have anything really to do with risk the way that it has always conventionally done. It instead has to do with major deglobalization, de-dollarization, structural changes in how companies and banks hold their reserves. So that's what's happening with treasuries. Gold's doing well because guess what? All of these big change is risky. And so when big change happens, people buy safe havens, and they are doing that with gold, especially because the treasury as a safe haven, it'll still happen. If the Gaza war explodes, expands, gets way worse, you will still see a rush of people into treasuries. Like I say, this is a slow change. But gold is a constant. Gold is a safe haven, and that's why the gold price has been doing really well. Underlining all of that is just central bank buying, which hasn't been a recent change. Over the last 2 years, central bank buying has dramatically increased, again, as part of the same thing. This is de-dollarization. This is de-globalization. This is countries. If you look at the the chart that shows central bank buys, it's actually really interesting. If you look at disclosed versus undisclosed, in the last 2 years, all of a sudden the number of undisclosed central bank buys, so this is central banks, the World Gold Council knows who they are, they're buying gold, but those banks have told the World Gold Council to not say who they are. All of a sudden, the number of undisclosed central bank gold buys has shot through the roof. There's a whole bunch of sort of BRICS nations, de-dollarizing nations, who are slowly but surely gathering gold. So that's been sort of the fundamental support. Then you get this risk piling on top. That's supported gold really well. And yields are doing their own thing for different structural reasons.
Where do you see this whole debt situation headed? Is there a solution? If I was to put you in charge of the debt situation in the United States, what would you do? Is there a way out, or is the only option here to just continue to print, perhaps, and kick the can down the road?
Well, like Jay said, that option has absolutely worked for a very long time. But what is changing is this erosion of the buyer's pool for US debt. And that is a real thing. I mean, I have long ignored all of the conversations about US debt and, the end of fiat currencies. I've long ignored them because I was like, yeah, sure, I get what you're saying, but we're going to keep kicking this can. We're going to keep printing money because everybody will always buy treasuries. That is the thing that is changing right now, is that there isn't always a huge, so in the near term, the things to watch, I mean, over the next while, the things to watch are, the bid cover ratio on treasury auctions. Like if we actually get to the point where the US government is putting up treasuries for auction and there is an insufficient bid cover ratio, you will see a big reaction. The T-bill market is the biggest, most important market in the world. And if you start to see failed treasury auctions, yields will do things that will cause chaos elsewhere. T-bill yields really matter. If we get a failed treasury auction and T-bill yields, if the 10-year goes to 6, 7, 8%, you will have a stock market crash. Like that these things are connected. I'm like Jay, I'm not trying to time this, but I am paying attention now after many, many years of not paying attention, because I do think that there's a structural change that China, Japan, there is not this endless deep pool of buyers for US treasuries. Like I say, I'm not going to try and time it. I don't think that I'm going to say when this will happen, but it is happening. And I think it's important to pay attention to. You asked me what I would do to fix things. I don't pretend. I'm not American, and I don't pretend to understand how that government, what paths out there are for that government. I don't know. I don't see it. Like I said in my previous answer, I don't see a way for them to change their deficit situation, because Democrats will always stymie cuts to entitlements and Republicans will always oppose tax increases. So I don't know. Something big has to change there. That's these kinds of, I don't know, what on earth could it be? That's what leads to these arm wavy, oh my gosh, end of fiat currencies, structural collapse, blah, blah, blah. Because people are like, well, I don't actually see another alternative. Humans are ingenious. Something will happen, whether it makes a huge disaster into a small disaster, a medium disaster, I don't know. It's not going to be pretty, but humans are ingenious. Something will happen. And I don't pretend to know what that will be. But this structural change of an insufficiency of treasury buyers is real, and it's something I think that we should pay attention to.
Well, let's switch over to investing in the commodity space specifically. Jay, you just released a course, the Commodity University, giving an introduction to the commodity space. Gwen, obviously you have a wealth of experience there. Before we dive into your individual stock picks, the sectors you're looking at, I'd like to pose the question, for those watching who might be new or even intermediate investors, what are the biggest mistakes that you see investors in the commodities and mining sector make, and how do you think they could correct them? And Jay, I'll start with you on this one.
Sure, man. So some of the biggest mistakes I see commodity investors make are so two things: running in too aggressively into super high risk bets, because there's a lot of excitement around junior mining and penny stocks and speculative assets. And I get it. Like, I love that industry. I love the early stage stuff. I really do. But in order to play there, right? It's very important that you've built the other side of your barbell out sufficiently so that if everything goes south on the speculative end, or it takes 5 years longer than you thought it would to get some liquidity inside that market, you've got enough on the other side, the stable side of the barbell, right, to see you through. Because rule number one is stay at the table, right? And if you look at any of the most successful investors in the commodity sector, names that, we all have as mutual friends, people like Rick Rule, the reason the reason they've accomplished what they've accomplished is because they stayed at the table. They never bet more than they could afford to lose. And what I see way too frequently is investors going way too aggressively, way too deep with cash they can't afford to lose, but they're really banking on that 10 bagger. It doesn't occur and they get wiped out, and then they're turned off the market, right? And they leave the game. It's funny. It's an analogy that extends far outside of just the stock market, but it exists. And secondly, Jesse, it's a fear of asking stupid questions. I see this a lot, like at my conferences and subscribers to the newsletter and all this stuff. There's a lot of like ego and just intimidation in finance in general and in the commodity sector. And so investors don't want to raise their hand and ask the dumb question, right? They just will assume or they'll pretend that they know to their own demise, And you mentioned the course that we built. Yeah, that was the reason we built that course. We wanted to build the commodity university. It's like the 101. And it starts with the absolute fundamentals for anybody looking to build a portfolio in the commodity industry, assuming you know nothing, right? And that was how we structured that curriculum. It's like, let's not build the course for the investor that's been here 10 years. Let's build the course for the investor who, literally chapter 1, as Jesse, it's what is a commodity, right? And then chapter 10 is portfolio construction, and everything in the middle is risk, management and supply and demand dynamics and economic indicators and all that stuff, important stuff. But we really peeled it down to the basics. So, self-promote, thecommodityuniversity.com, go check it out. But that would be it. And then, I just want to touch on some of the stuff that Gwen shared, because, I detached myself from the conversations about like, when's the debt bubble going to pop? And, are we in a recession, and what's inflation going to do? Because I can't time those things. And so frankly, I tend to back off of tying my portfolio too closely to events on a timeline like that. But everything that Gwen said is like front and center for me in terms of us going through a pretty big tectonic shift globally right now. My whole life, for example, has been the era of increased globalization. And, we're seeing that shatter. It's gone. It's not coming back. I think that wasn't the mean. It was the anomaly. And now we're reverting to the mean, which is a more fragmented global economy. Just means less sharing of everything, less demand for US dollars, countries looking for optionality outside of the US dollar market. We're seeing that. That's the de-dollarization trend. And yes, it's small and it's on the margin, little oil deals occurring between certain countries. Russia's selling to India for rupees, but what are they going to do with rupees? So it doesn't really make sense, like there's a lot to work out there, but the trend, these events aren't isolated, right? They're part of a trajectory. They're part of a trend. And so that's when Gwen says it's important to pay attention. Like that's why, because these little events on the margin that don't seem like much today become something big eventually, right? And I think that wave is absolutely heating up. How does that relate to the commodities market and my portfolio? It's like, well, if the world is a global marketplace, globalization, where we're going to buy and sell whatever we want from whoever we want, as long as we have the cash or credit to do so, then the supply of everything's pretty abundant, right? Whatever it is you need, whether it's copper, uranium, silver, iron, it doesn't matter, right? You can buy it from the seller, nickel. But in an era where we're not sharing like we used to, the supply of everything becomes pretty vulnerable and unpredictable, right? When the supply of something becomes vulnerable, unpredictable, the value of that thing goes up, right? And that's like at a super high level, my base case for a commodity super cycle. But these cycles don't happen in a straight line. It's not like a straight up to the right curve, right? It's like incredibly volatile. And so step back from the noise that you can't predict, the short-term volatility, revisit your long-term thesis and your time horizon and say, like, I don't know what the world's going to look like in a quarter or two, but I can make some assumptions about what it's going to look like in 10 years. And that's actually a lot easier to do, right? And then you can build your portfolio around that mindset. And it does two things. I think it sets you up for success. Like duration is what wins. I mean, that's the Rick rule, but like that's everybody. Warren Buffett, for example, he's only Warren Buffett because he's been an investor for 80 years. Like he started when he was 13. He's still going in his 90s. If he had applied the same portfolio strategy, but only been an investor for 30 years, he'd be worth less than 1% of his current net worth, and nobody would have ever heard his name. It's duration that got him there. It's time horizon that gets you there, right? But we want to be rich tomorrow, and so we focus on near-term events and what can I buy today that'll pay. It's like, just chill, back off, take some time, right? And be patient, right? Trust the process and be patient. So ask the dumb question. Don't bet what you can't afford to lose, and be patient and trust the process. That's what I would recommend all commodity investors pay attention to. I've been a commodity investor for over 15 years, and I'm the host of one of the world's largest commodity investment conferences. I teach a 10-chapter course on commodity investing for beginners. No complex strategies, just actionable information. Our comprehensive course breaks down the complexities so you can make informed decisions and gain financial freedom. I'm Jay Martin, and this is the Commodity University.
Very well said, and definitely makes sense on the time horizon. Warren Buffett famously looks to invest in companies that he hopes to never sell, and a lot of investors in this day and age can't wrap their heads around that concept, especially with the advent of social media. Gwen, what are the biggest mistakes you see commodities investors making, and how could they correct them?
I mean, Jay gave a pretty fantastic answer there. There's a few things that I will add on top of in agreement with all of those things. I think the idea of going too far in on speculative, there's a few things that I'll add to that idea. I think investors often don't understand how complicated and how complicated the exploration space is. So if you're going to start betting on junior exploration, there are a lot of factors in any one story that you need to understand. And so discounting the complexity, because with complexity comes, ways that things cannot work. And so there's a lot of ways that junior mining stocks can fail to work. They certainly can work as well. When you hit the discovery, and it's phenomenal, and that's the exciting thing, and that's what draws everybody in. But it's very complex. So I think asking what you think are the dumb questions and really trying to understand the story is essential. Then the patience thing is so key. And Jay was talking about that as a big picture approach to investing. It's also important in the individual stocks. And so there's a balance there. If you have to have a thesis for each stock that you own. And that isn't that I love Explorer, Goldfields ABC, and I'm just going to own them until they hit a discovery. That is not sufficiently detailed as an investment thesis for that stock, because these stocks are complex. So you need to say, I love this company because this target, has these pieces of evidence, and this is the approach that they are going to use to test it. And my thesis is that will generate a positive response, whether that's, hitting into the discovery right away or hitting into signs that they're close to it. Those are details, but you need to have an actual thesis for why you own that stock. And if that thesis fails, you need to leave or come up with a new thesis. Okay, that didn't work because blah, blah, blah. That means we're going to approach it differently, come at it from another angle, step to the side, whatever it is. Now I have a new thesis for this stock. Don't just keep holding it because the president likes to call you up and promote you on how excited he is about the next thing that they're going to do. Actually have a thesis for why the target's going to work, the project's going to work, whatever it is. It needs to have detail because these things are complicated. So that response is very, of course, focused on the speculative, the junior mining space. But a detailed thesis is the thing that I would really advocate, because just holding stocks in the hopes, because the promoter tells you that it's going to work, that's not going to work. And then be very, always question your sources of information. I was just recording a little reel this morning about whenever, as investors, I'm sure you both get lots of emails that show up in your inbox that are like the breathless headline, and then the article that's all about this stock that's primed to shoot to the sky, right? Just as an investor, you end up on these lists, and then you're like, stop it, man. If you see those kinds, and one of them you're like, oh, that actually sounds interesting, the very first thing you need to do is read the disclaimer. Always, always read the disclaimer and find out if the person who was writing that article was paid to write it. Because if they were paid to write it, I don't see any reason why you should listen to what they say at all. The writer's goal is to get a paycheck. The company's goal is to boost their share price. This isn't about helping you at all. You should only heed information, content that comes from people who are actually trying to help you. So those are just always question the source. Is the promoter there to help you? No, the promoter is to lift his share price and probably fill his financing. So he's not actually there to help you. You need to find people who are in your corner. Find your own team who you can work with to trade ideas, to poke holes in investment theses. Find your team and trust that information, not the information that just comes at you. And if you are going to read the information that comes at you, always read the disclaimer.
Nice. Yes, a ton of actionable advice from both of you. So really appreciate that. Let's get into the sectors and the companies that you're both currently either watching or investing in. Gwen, I'll start with you on this one. Where are you currently looking for value? And if there's any company names you could share with us, that'd be great too.
For sure. So I've become quite focused in my portfolio in the last little while because things are muddling along, right? This metals market is just sort of muddling along. And what, like Jay and I have been saying, we can't time when things will change. So I don't want to just hold things, because they'll be worth more when investors care about gold stocks again. So I've been looking for things that I have two categories of things in my portfolio. One category is stuff that I think has a good chance of generating returns in the near term. And there's two things therein. There is discovery stories. So if a company does hit into that great copper discovery, gold discovery, whatever it is, those discoveries, really good ones, perform no matter what the market's doing. The market could be terrible, muddling along, hot. Those discoveries perform no matter what. So I have a set of pre-discovery stocks where I really have where I have a lot of anticipation about the testing of those targets. I have reason to believe that there's good odds. And so, they're not all going to win. This is discovery. Lots of them don't, but I have a set of discovery stories that I really like, and I'm going to hold on to those because they can work no matter what happens in the market. The other thing in the near-term basket is uranium, because as Jay mentioned, uranium has decoupled from the rest of the commodity world. It's doing the supply-demand thing that the other commodities need to do in a little while, but it's doing it sooner for a whole bunch of reasons that we could spend the next hour talking about, but I won't get into now. Uranium is going, so there's opportunity in the uranium space. And then the other side of things are those deep value opportunities. Jay spoke about this. There's absolutely companies out there. There's mining companies and there's advanced gold development companies. So these are companies that have a project that could in the next few years be built into, or is already being built into, a large, long-lived mine. But these projects are getting no love. Their share prices are very low. So those are the deep value ones. But that deep value is not going to surface until the gold price moves to a point and the risk sense in the market is such that people want to start buying gold stocks. We're not there now. I don't know when we're going to get there. At some point, I think we will. I really do think that gold is going to perform sometime in the next little while. And to an extent that the gold equities will have to sort of come along with it. And whether that's because of a recession or whether that's probably because of a recession and negative things going on in the space, or potentially alongside a metals bull market if we happen to glide through and get to growth without a recession. But I do think gold is going to work, and so that deep value will surface at some point. So I have those, but those are the ones that are going to require patience. Those are not ones where I'm expecting returns anytime soon. But the deep value is very deep right now. So to give some names in each of those, on the discovery front, I'll name Black Wolf Copper and Gold. They've tested 2 targets up near Stewart, BC. One happens to be on the Alaska side. The results from that are really soon. Those targets look really good. Another one in that part of the world, actually just up in Yukon, that I quite like is called Cascadia Minerals. CAM is the ticker. That's a really cool story. A spin out from a company that got taken out. Got taken out for a project in West Yukon, ATAC, the Rakla project. They had already started diversifying and finding some copper opportunity in the other part of Yukon. And really, this is a terrain of BC that's really known for copper gold porphyries that extends into Yukon, but nobody had ever really paid attention to the Yukon part of that Stickeen terrain. So they have gone in there, they found, blue rocks full of what looks like copper sticking up out of the ground. I really like that as a discovery potential story. So Cascadia and Black Wolf are my discoveries. In the uranium space, there's lots that you can bet on. I really like this merger of ISO Energy and Consolidated. I think they're creating an uber uranium junior that sort of will have the capacity, the backing from NextGen, so the capital, will have the liquidity, will have the number of projects, that it will get carried along in a very nice way with that sort of discovery potential upside, because it's also got discovery stuff going on. I think that's going to work really well in this market. So I really like that. You can buy either stock. They haven't finished that merger yet. It was only announced a couple of weeks ago. And then on the deep value side, I mean, pick your bet. Like Troilus is one. Marathon is building a mine right now. They're trading at, I want to say, under $300 million for a project that is 50% built and has an NPV at like 1650 gold of 1.4 billion. Like the numbers are, the deep value is very deep. So I think there's deep value out there, but those are the ones that are going to require patience.
Awesome. And Jay, the sectors and the companies that you're currently watching or investing in?
Sure. So a few things that are catching my attention. First, I talked about how the gold price might be stable or rising because, it's a fear-driven bet. And when it's a fear-driven bet, there's less risk tolerance. That's why the equities aren't getting any love. But eventually that fear-driven bet turns to a greed-driven bet because the gold price does rise to a place where, the economics of the miners make way more sense, and greed will overtake fear. Like that's the trade that we're waiting for in the precious metals sector. And again, I don't know when that's going to happen, but cyclicality tells you that it's going to happen. And the commodity sector as a whole, like I am bullish on the industry, but you'll see little pockets of rallies, right? Like lumber ran, then pulled back, then ran, then pulled back. Energy ran, pulled back, it's running again. Uranium's been quiet, now it's running, right? You look at a chart of live cattle futures, it's bananas. It's like the hottest chart in the world right now, right? Grain, same thing. But these rallies don't occur simultaneously. They happen in little pockets. And so it's very tough to determine when a rally is going to hit precious metals, for example. But when they hit quite fast, right? And things change really, really quickly. And that's when you see a lot of panic buying, right? Which provides liquidity to those that were early, right? And I'd rather be early and patient than panicking and then chasing a share price. So that's kind of my general thesis. I'm quite heavy in the precious metal juniors right now, similar to Gwen though. Like when in my newsletter, I talk about if I've entered a position and immediately I'll get a response from subscribers saying, or making the assumption that means I think that price is going to rise this quarter. That's what me taking a position means, is that I'm expecting the price to go up this quarter or next. And that's not what I mean. What I mean is that I think it's cheap right now. That's why I'm buying it. Back to that, right? So I'm quite exposed to the precious metals, a little bit of exposure to copper. If I had some concerns about the copper sector, it's just that, call it Dr. Copper, the barometer, the economic barometer. If we enter some kind of a global coordinated recession, will that depress copper prices? Possibly, but I leave it at a possibly because, Jesse and you and I were speaking in a different interview looking at, demand of energy, for example, during hardcore recessions, right? And if you look back at the global oil consumption, over the previous 15 years, you could expect to see during events like the 2008 financial crisis, a massive depression in oil demand. But oil demand decreased by slightly over 1% in the great financial crisis. And on a 15-year chart, you'd actually don't even notice it. It's a blip in the radar. 2020, when we shut the entire world down, like locked cars in the garages, airplanes on the tarmac, hotels shuttered, global oil demand dropped by about 8%. You might have expected 50, right? Given that nobody was moving. But, these are little blips in the radar. Like humans are still moving right up and to the right. We're going to progress and grow and we want things. So, I really question the whole demand destruction thesis. That's where I'm going with that one. But so I could mention a couple names that I'm looking at right now. And I would preface that, even though I love the speculative sector, I only go there when I'm super confident that I've buffed out the stable side of my barbell. And for me, that's boring assets like physical gold, like cash, like real estate. And then even in the precious metal sector right now, I've got quite a lot of exposure to cash flowing gold producers that I love a lot. And again, it's just because I can buy them with no competition on the open market. And I love the valuations. You can find great management teams with 2 or 3 records of success in their back pocket. And nobody cares. So I'm typically a very people-driven investor, and depending on what your area of expertise is, like that should direct you. I talk to people for a living. I host a conference, so I know people. I don't look as closely at the rocks. Brent Cook gives me shit for that. He says you're missing a big part of the story by not going deep into the geology. And I tell Brent, no, you're a geologist. That's what you should do. But I talk to people for a living, so I assess the resumes. And frankly, anybody can play that game, so it's not a bad game to play. So two super early names I'll mention, Jesse. One would be Midnight Sun, and I think worth a look. So it's a copper project in Zambia, and the reason they're on my watch list right now is because there's a lot of majors sniffing around Zambia for copper projects, and specifically one really interesting company called Cobalt Metals, which is actually a Silicon Valley born startup, now a $1 billion company that's applying essentially AI to create a Google Maps of the Earth's crust. And the funders and founders of Cobalt are Jeff Bezos and Jack Ma, Bill Gates, and Richard Branson. And they have already deployed about $150 million into junior mining companies. And a lot of that cash has found copper deals in Zambia, very similar to what Midnight Sun is sitting on. Doesn't mean Midnight Sun's going to get a deal done there, but if they do, I'm really interested in it, right? So I'm watching that development really closely. I've been waiting for when the tech sector is going to marry the mining sector, because it was only a matter of time. You can't build the future we've been promised without the minerals that are the ingredients to, baseload power, smart cities, electric vehicles, all this stuff. So now Silicon Valley's waking up and starting to finance exploration, which is going to hopefully massively expedite the projects and reduce cost and efficiencies. We'll have to wait and see. So, and then the second one is a company I'm, full disclosure, I'm a very large shareholder of, and they talked me into being a director. So that is what it is, but it's Stallion Discoveries. And they've been super quiet for the last 2 years, just buying property in the Western Athabasca Basin. They've now got over 3,000 square kilometers. They're the largest landowner in the Western Athabasca. And the two individuals directing the land acquisitions are Stephen Stanley and Matt Mason, who founded and built Hathor and then sold to Rio Tinto in 2012 for about 620 million. So, good eyes on the ground there, and but super quiet, super speculative, very early stage. But one to watch because it's my only exposure to the uranium sector, and it's a big swing, but worth a look. So have a peek at that.
Great. Well, thanks to both of you so much for joining me. Before I do let you go, Gwen, tell us about Resource Maven.
Oh, thanks. Resource Maven is my newsletter. I write a weekly newsletter about what I'm doing with my money in the mining space and why I'm doing it. It's a subscriber-supported newsletter, and you can find out anything you want to know about it at resourcemaven.ca.
Awesome. And Jay, you alluded to the Commodity University. Maybe you could give us a little bit more info.
Yeah, thanks, Jesse. I'm so pumped on this, man. It was so fun to produce, and it was in direct response to conference attendees asking us, newsletter subscribers asking us, how do I get started in the commodity sector? So, there's like 100 answers to that question, and they're all kind of right. And so we just built this course that is hopefully, it's the one-stop shop for anybody hoping to understand the fundamentals and how to begin building a portfolio in the commodity sector. So it's 10 chapters, lecture-centric, led by myself. I'm joined by tons of friends who lean in with their expertise. So it's like you get an academic lesson and then some, on-the-street investor experience shares. Here's how I implement this material. So tons of fun. thecommodityuniversity.com. Check it out if you're interested.
Awesome. Well, thank you once again to both of you for joining us today. This is the pre-VRIC Summit. Myself and Jay are going to be hosting some other conversations coming up, so we really do hope you'll stick with us. There's a ton of useful, actionable information, and stay tuned for more.